The Hidden Laws of Wealth series, Decoding the Market via Microeconomics, Chapter 2, Supply Demand and the Invisible Hand Part 1, The Illusion of the Order Book, Episode 1, The Theater of Lies. Welcome to Chapter 2. If Chapter 1 was about mastering your own mind, Chapter 2 is about mastering the battlefield. We are going to talk about supply and demand. Now, if you open the economics textbooks I see on your desk, you will see a very pretty picture. You see a line going up called supply. You see a line going down called demand. They cross at a point called equilibrium. The price. It looks so neat. It looks so fair. It suggests that price is a democratic agreement between buyers and sellers. I am here to tell you that this is a lie. The stock market is not a democracy. It is a dictatorship. And the dictators are the people with the biggest volume. Most of you start your day by opening your trading app. You look at the order book. You see the columns of buy orders on the left. You see the columns of sell orders on the right. You see the numbers flashing, green and red. You think you are looking at data. You think you are looking at the truth. But you are actually looking at a theater performance, and you are the audience member who does not know it is a play. Let me explain the first illusion of supply and demand. The concept of visible versus hidden liquidity. In microeconomics, demand is the willingness and ability to buy. But on the stock market screen, what you see in the buy column is not the true demand. It is only the advertised demand. Think about it. If you are a shark and you want to buy 10 million shares of a company, do you put a buy order for 10 million shares on the screen for everyone to see? Of course not. If you show your hand, the price will run away from you. Sellers will raise their prices. Other sharks will jump in front of you. So the real demand, the demand that actually moves the market, is never on the screen. It is invisible. It is hidden in dark pools. It is hidden in algorithmic execution bots that only buy when you sell. So what are those big numbers you see on the screen? You see a massive buy wall at a certain price. 50,000 shares waiting to be bought. You think, wow, that is strong support. There is a lot of demand there. I should buy too. Wrong. That wall is often a fake. In the industry, we call it spoofing. A whale puts a huge buy order on the screen, not because he wants to buy, but because he wants you to buy. He wants to create the illusion of high demand. When you and thousands of other small fish see that wall, you feel safe. You step in and buy. You push the price up. And guess who is selling to you at that higher price? The same whale who put up the fake buy wall. Once he has sold his shares to you, he cancels his big buy order. The wall disappears. The support vanishes, and the price crashes. This is the difference between academic economics and street economics. In the classroom, supply and demand are static forces. In the market, supply and demand are weapons used to deceive. The numbers you see on your screen are not there to inform you. They are there to manipulate you. The order book is not a map of the market. It is a map of where the trap is set. So, the first rule of decoding supply and demand is this. Never trust the visible liquidity. The things you can see are usually traps. The things you cannot see are what will kill you. But how do they hide? How can a whale move millions of dollars without leaving a footprint? In the next episode, I am going to introduce you to the most dangerous weapon in the shark's arsenal. It is called the Iceberg Order. And it is the reason why support levels break just when you think they are safe. Welcome to the real game, the Hidden Laws of Wealth series. Decoding the Market via Microeconomics, Chapter 2, Supply, Demand, and the Invisible Hand, Part 1. The Illusion of the Order Book, Episode 2, The Assassin Beneath the Surface. Welcome back to the Theater of Lies. In the last episode, I told you that the large buy orders you see on your screen are often fake. They are traps designed to lure you in. But today, I want to talk about something far more dangerous. I want to talk about the order that is real, but you cannot see it. In the ocean, a ship does not sink because of the ice it can see. It sinks because of the massive block of ice hidden beneath the water. The stock market is exactly the same. The orders that kill you are the ones that never show up on the order book. We call them Iceberg Orders. Let me take you inside the mind of an institutional trader, a shark. Imagine I am a fund manager and I need to sell 5 million shares of a tech company. I know the current price is $100. If I simply press the sell button for 5 million shares, what happens? Panic. The market sees this massive sell order. Buyers disappear. The price crashes instantly to $90. I lose millions of dollars in seconds due to slippage. I have destroyed the very market I am trying to exit. So, I do not do that. I use an algorithm. I use an iceberg. I tell my computer, I want to sell 5 million shares at $100, but only show 500 shares to the public at any one time. Think about that. 5 million hidden, 500 visible. Now, you are the retail trader. You look at your screen. You see a sell order for only 500 shares at $100. You think, oh, that is a small seller. I can buy that. The supply is weak. So you buy those 500 shares. You feel good. You think you cleared the resistance. But the moment your trade executes, my computer instantly reloads another 500 shares at the same price. Another retail trader comes along. He sees 500 shares. He buys. My computer reloads again. It goes on and on. You and thousands of other retail traders are buying and buying, thinking you are breaking through the wall. You throw all your capital at this price level. But the price does not move. It stays stuck at $100. Why? Because you're not fighting a small seller. You are chipping away at a frozen mountain with a plastic spoon. You are providing liquidity for me to exit. You are the meal. This is the true mechanics of supply. Supply is not what is sitting on the shelf. Supply is what is kept in the warehouse, waiting to be brought out the moment you show interest. So, how do you spot an assassin that is invisible? How do you know if you are swimming into an iceberg? You must stop looking at the size of the orders and start looking at the behavior of the price. If you see a price level that refuses to break, even though there is heavy buying volume, you are hitting an iceberg. If you see the buy column filled with aggressive orders, but the price does not tick up a single cent, someone is feeding you shares from a hidden inventory. This is the moment of maximum danger. Because eventually, the buyers will run out of money. The retail crowd will exhaust themselves. And when the buying stops, I will still have 2 million shares left to sell. And what do I do then? I lower my price. I move my iceberg down to $99. And the floor collapses beneath your feet. The iceberg order is the ultimate weapon of supply. It allows the big money to hide their true intentions. It turns the concept of transparency into a joke. But hiding is only the defensive strategy of the sharks. Sometimes they need to be aggressive. Sometimes they need to come out of the shadows and hunt. They know where you put your safety net. They know where you put your stop loss. And they are coming for it. In the next episode, we are going to talk about the most violent maneuver in the market: stop hunting. I will explain why the price always seems to hit your stop loss by exactly 1 cent before reversing and going to the moon. Prepare yourself. The hunt is about to begin. The Hidden Laws of Wealth Series. Decoding the Market via Microeconomics, Chapter 2. Supply, Demand, and the Invisible Hand, Part 1. The Illusion of the Order Book, Episode 3. The Hunt for Your Stop Loss. Has this ever happened to you? You buy a stock. You set a perfect stop loss just below the support level to protect your capital. The price drifts down, touches your stop loss by exactly 1 cent, and kicks you out of the trade. And then, the moment you are out, the price reverses and rockets upward without you. You feel like someone is watching you. You feel like the market is personal. I am here to tell you that you are right. Someone was watching you. But it was not a ghost. It was the big money. Welcome to the most violent maneuver in the financial markets: the stop hunt. To understand why this happens, you have to understand the true meaning of liquidity in microeconomics. Most people think liquidity is just having a lot of buyers and sellers. But for a whale, liquidity is a problem that needs to be solved. Imagine I am a market maker or a large hedge fund. I want to buy 1 million shares. But there is no one selling that much at the current price. If I just start buying, I will push the price up and destroy my own entry. I need a massive pile of sell orders to hit my buy orders. I need a liquidity pocket. And where is the biggest pile of sell orders located? It is sitting right below the support level. You see, your stop loss is not just a safety net. Technically, a stop loss on a long position is a sell market order. When the price hits that level, your order is triggered and you become a seller. Every retail trader in the world is taught the same thing: put your stop loss below the recent low. So, thousands of retail traders place their stop losses in the exact same spot. For a whale, that spot looks like a giant neon sign that says, "Free liquidity here." I do not move the price down to hurt you. I move the price down to fill my orders. I use a small amount of capital to push the price just below that support level. I want to trigger your fear. I want to trigger your stops. The moment the price breaks that level, a chain reaction happens. Thousands of stop losses hit the market at once. A massive wave of selling enters the order book. And I am standing there on the other side with my mouth open. I buy every single share you are panic selling. I absorb your fear. I use your sell orders to fill my massive buy order without moving the price up. Once I have filled my position, I stop selling. The selling pressure evaporates because all the retail traders are already kicked out. Now, with no one left to sell, even a small amount of buying makes the price explode. This is why the market always seems to reverse right after you sell. It is not bad luck. It is a liquidity sweep. The sharks do not want your money. They want your shares, and they want them at a discount. So, how do you survive the hunt? You must stop thinking like a victim and start thinking like a predator. You must learn to identify where the liquidity pools are located. Stop putting your stop loss where everyone else does. If the support level is too obvious, it is a trap. In the next episode, we are going to talk about the liquidity traps. I will show you how whales create fake breakouts to lure you into the wrong side of the market. Because sometimes, the sharks do not want to buy your shares. Sometimes they want to sell you theirs at the highest possible price. The theater continues. The Hidden Laws of Wealth series, Decoding the Market via Microeconomics. Chapter 2, Supply, Demand, and the Invisible Hand, Part 1. The Illusion of the Order Book, Episode 4. Market has a special way of rewarding your impatience with a heavy dose of pain. Think back to the last time you saw a stock trading sideways for weeks. It hits a ceiling, a resistance level, over and over again. You are waiting. The whole world is waiting. And then, suddenly, it happens. A massive green candle breaks through the ceiling. The volume spikes. Every indicator on your screen screams buy. You think this is it. The breakout. If I do not jump in now, I will miss the rocket ship. So you buy at the top of that candle. And then, the trap snaps shut. The price stalls for a few minutes, then reverses violently. It falls back below the resistance level, faster than it went up. You are left holding the bag at the highest price of the year. Welcome to the liquidity trap, commonly known as the bull trap. To understand this, we must go back to our core principle. Big money needs liquidity exit. If a whale owns 5 million shares and wants to take profits, he cannot just sell. If he sells into a quiet market, he will push the price down so fast that his average exit price will be terrible. He needs a surge of buying power to absorb his massive supply. He needs you to be excited. He needs you to be greedy. So the whale creates the breakout. He uses a small portion of his capital to buy aggressively, pushing the price just above the well-known resistance level. He knows that thousands of retail traders and thousands of automated bots are programmed to buy the moment that level breaks. He is literally engineering a stampede of buyers. As soon as you and the rest of the world start rushing in to buy the breakout, the whale does not join you. He meets you. Every buy order you place is filled by a sell order from the whale. He is using your FOMO, your fear of missing out, as a golden bridge to escape his position. You are providing the liquidity he needs to sell his millions of shares without crashing the price. Yet, once the whale has finished dumping his shares into the hands of the excited crowd, the buying pressure vanishes. The whale is gone. But the supply he just dumped is now in the hands of weak retail traders. When the price fails to go higher, the excitement turns to doubt. Doubt turns to fear. And when the price falls back below the resistance, all of those breakout buyers realize they are trapped. They start to sell, and the price collapses. In microeconomics, we call this an artificial shift in demand. It is a temporary spike manufactured to hide a massive, permanent increase in supply. The sharks do not just react to the market. They build the market to suit their needs. So, how do you avoid the trap? You must wait for the test. A real breakout is usually followed by a calm retest of the old level. A breakout is followed by a violent reversal. Stop being the first one through the door. The first one through the door is usually the one who gets shot. In the next episode, we are going to look at the gaps. Those mysterious empty spaces on the chart where the price jumps overnight. I will show you why gaps are the ultimate manifestation of supply and demand imbalance, and how to tell if a gap is a sign of strength or a final gasp of exhaustion. Stay liquid. Stay patient. The Hidden Laws of Wealth Series, Decoding the Market via Microeconomics, Chapter 2, Supply, Demand, and the Invisible Hand, Part 1. The Illusion of the Order Book, Episode 5. The Deadly Gaps when Demand Vanishes. Imagine you are at an auction. The last bid was $100. You expect the next bid to be 101, then 102. That is a continuous market. But suddenly the auctioneer screams, $100 bid. Do I hear 150? 200? Sold at 300. What happened to the prices in between? Where did 101 to 299 go? In the stock market, we call this a gap. It is a mysterious empty space on your chart where no trading occurred. It is as if the price teleported from one reality to another. Most retail traders see a gap and think it is an error or just a bit of excitement. But to a shark, a gap is the ultimate manifestation of supply and demand imbalance. It is a declaration of war. In microeconomics, we talk about price discovery. Usually, buyers and sellers negotiate every cent of the way. But a gap tells you that the discovery process has failed. If a stock gaps up 10% overnight, it means at the old price, demand was so overwhelming and supply was so non-existent that the market had to jump to find a single person willing to sell. The sellers at the lower prices did not just raise their prices. They vanished. There are 3 types of gaps you need to recognize if you want to survive. The first is the breakaway gap. This is the sound of a prison break. After weeks of sideways movement, the price gaps out of a range with massive volume. This is the whales slamming the door shut. They are saying, the cheap shares are gone. If you want in, you pay the premium. This gap rarely gets filled. It is a sign of true, violent strength. The second is the runaway gap. This happens in the middle of a trend. It is the sound of FOMO. It is the sound of the late crowd finally realizing they are being left behind and rushing the gates at any cost. It is a sign that the trend is healthy and aggressive. But the third one is the most dangerous. We call it the exhaustion gap. This happens at the very end of a long move. The price gaps up one last time, often on record-breaking volume. It looks like the ultimate sign of strength, but it is actually the final gasp of a dying animal. The whales are using this final gap to create a liquidity event. They push the price up so fast that everyone feels they must buy now or lose forever. The sharks are selling their final shares into this vertical jump, and then the gap is filled. In the industry, we say gaps always get filled. This is not strictly true, but when an exhaustion gap gets filled, it is the kiss of death. It means the demand that caused the jump was fake or temporary, and the massive supply of the whales has finally overwhelmed the market. When you see a gap, do not chase it like a dog chasing a car. Ask yourself, is this a door opening or a trapdoor closing? A gap is a vacuum, and the market hates a vacuum. In the next episode, we're going to look at the mechanics of the execution. We will talk about aggressive versus passive orders. I will show you who really controls the price. The person waiting in line, or the person who is willing to pay a price to get in now. The invisible hand is about to get very heavy. The Hidden Laws of Wealth Series, Decoding the Market via Microeconomics, Chapter 2, Supply, Demand, and the Invisible Hand, Part 1. The Illusion of the Order Book, Episode 6, The Aggressors and the Wall. Have you ever wondered who actually moves the price? You see millions of shares being traded, but the price stays perfectly still. Then, 5 minutes later, a tiny trade happens, and the price jumps 1%. It feels random. It feels like the market is broken. But in microeconomics, there's no such thing as a random price move. There is only the battle between two types of players, the makers and the takers, passive liquidity and aggressive execution. To understand the market, you must stop looking at the volume as a single number. You must ask, who is the aggressor? On your screen, the order book is filled with passive orders. These are the limit orders. People waiting in line. They say, I am willing to buy 99, but not a cent more. Or I will sell at 101, but not a cent less. These people are the makers. They provide the liquidity. They are the walls of the fortress. But walls do not move. The only thing that moves the price is an aggressive order. The market order. This is the person who says, I do not care about the price. I need to get in now. Or I need to get out now at any cost. These are the takers. They are the battering rams. A price only moves when an aggressive buyer is willing to eat through all the passive sell orders at a certain level. Think about this deeply. When you see a massive green candle, it is not just buying. It is aggressive buying. It is a taker running through the sell walls like a hot knife through butter. Demand has become violent. There is where it gets interesting for the shark. Absorption. Imagine a whale wants to sell. He does not use a battering ram. He becomes the wall. This is a massive passive sell order, perhaps hidden as an iceberg. At $100, thousands of retail traders, driven by FOMO, start hitting the market by button dial. They are being aggressive. They are throwing their capital at the wall. The volume is huge. You see the green flashes. You think, wow, so much demand. The price is going to explode. But the price does not move. $100. $100. $100. What is happening? The aggressive demand is being perfectly absorbed by the passive supply. The whale is feeding the crowd. He is letting the retail traders exhaust themselves against his wall. In economics, this is a moment of extreme supply elasticity. The seller is willing to provide an infinite amount of shares at that specific price. And what happens when the aggressive buyers run out of ammunition? The wall is still there, but the buyers are gone. Now, the whale pulls his wall, places a small aggressive sell order, and the price collapses because there is no one left to support it. The lesson is this: high volume does not always mean a trend is starting. Sometimes high volume at a stagnant price means a transfer of wealth is happening from the aggressors to the walls. You must learn to see who is in control. Is the battering ram breaking the wall, or is the wall breaking the ram? In the next episode, we are going to talk about the only thing in the market that cannot lie: volume. I will show you how to read the volume profile to see exactly where the sharks have buried their money and where the real battlegrounds are located. The fingerprints are there. You just need to know how to look. The Hidden Laws of Wealth Series, Decoding the Market via Microeconomics. Chapter 2, Supply, Demand, and the Invisible Hand. Part 1, The Illusion of the Order Book, Episode 7, The Fingerprints of the Giants. They say the market is a place of secrets, but that is not entirely true. The sharks can hide their orders. They can lie with their walls. and they can manipulate the news. But there is one thing they can never hide: their footprints. In the world of finance, footprints are made of volume. Most retail traders look at volume as those little bars at the bottom of the chart. They see a big bar and think, a lot of people traded today. But that is useless information. It tells you when people traded, but it does not tell you where the real war was fought. In microeconomics, value is not a fixed number. Value is an area where the most exchange happens. To find the truth, you must stop looking at volume over time and start looking at volume at price. We call this the volume profile. Imagine a battlefield. After the war is over, you do not care what time the soldiers die. You care about where the bodies are piled the highest, because that mountain of bodies tells you exactly where the most important hill was. When you look at a volume profile, you see a horizontal histogram. The longest bars represent the prices, where the most shares changed hands. We call the longest bar the point of control. This is the fair value of the shark. Think about it. If a whale wants to buy 10 million shares, he cannot do it in a single second. He needs time. He needs to keep the price in a specific range for days or weeks to absorb all the selling. This creates a massive volume node. This node is a fingerprint. It tells you the big money is comfortable here. They have committed their capital at this exact level. Once you identify these high volume areas, the market becomes transparent. If the price is above a massive volume node, that node becomes the ultimate support. Well, why? Because the whales who bought there will protect their position. They will not let the price fall below their cost basis. But if the price falls below a high volume node, that area becomes a ceiling of death. Thousands of retail traders are now trapped at that price. They are praying for the price to come back just so they can break even. The moment the price touches that node again, a wave of break-even selling hits the market. The ghost of opportunity cost and the pain of sunk cost combine to push the price back down. The sharks use these volume nodes like bases of operation. They build a position at one level, then aggressively move the price to the next level to find more liquidity. Your job is not to predict where the price goes. Your job is to follow the footprints. Stop trading in low volume areas. Those are the no man's lands. In those areas, the price moves fast because there is no commitment. There is no support. You will get whipped around and destroyed. Follow the volume. Follow the commitment. Follow the giants. In the next episode, we are going to talk about absorption. I will show you how to tell the difference between a market that is stopping because it is tired and a market that is stopping because it has run into an invisible wall of 1,000 whales. The battle is heating up. The hidden laws of wealth. Theories. Decoding the market via Microeconomics. Chapter 2. Supply, Demand, and the Invisible Hand. Part 1. The Illusion of the Order Book. Episode 8. The Steel Wall. The Science of Absorption. Imagine a high-speed train rushing toward a station at 200 miles per hour. You expect it to take a long time to slow down, but suddenly, the train hits something. It does not derail. It does not explode. It just stops. It stays perfectly still, even though the engine is still screaming and the wheels are still spinning at full power. What happened? What happened? The train hit a wall that is stronger than its momentum. In the stock market, we call this absorption. And it is the moment where most retail traders lose their shirts because they mistake high activity for a continuation of the trend. In microeconomics, we study the elasticity of supply and demand. Usually, when demand increases, the price must rise to find new supply. But absorption is a freak of nature. It is a moment where supply becomes perfectly elastic. The seller says, I will give you every single share you want. 10 million, 15 million, 100 million, all at this one price. I'm not moving. This is the ultimate trap for the FOMO crowd. Think about the psychology. You see a stock in a powerful uptrend. It is moving fast. The volume is exploding. You see thousands of market buy orders hitting the tape. Everything looks bullish. You think this thing is going to the moon. But then the price hits a specific level. Let us say $100. Suddenly, the price stops moving. The volume continues to pour in. You see 1 million shares traded at $100 in 10 minutes. Then another million. The green flashes on your screen are blinding. The aggressive buyers are throwing everything they have at the market. But the price stays at $100. It does not move to 101. Not even for a second. This is the steel wall. This is the whale using passive supply to absorb every single drop of aggressive demand. The sharks are not fighting you. They are simply providing a bucket for your greed. Every time you buy, they fill your order from an invisible, bottomless pit of shares. They are transferring their position to you without letting the price move up an inch. Why do they do this? Because they want to exit their massive position without causing a panic. They need the crowd to be excited so they can sell into that excitement. The retail trader sees the high volume and thinks, wow, so much strength. But the professional looks at the tape and thinks, the buyers are exhausted. They are hitting a wall. The trend is dead. Absorption is the silent killer of trends. It is the moment where the momentum of the crowd meets the cold, hard capital of the institution. So, how do you know when the wall is about to break? Or when the train is about to collapse? You must watch for the tap out. Eventually, the aggressive buyers will run out of money. The screaming engine will run out of fuel. And the moment those buy orders stop, even for a second, the whale will pull his wall and push. The price will fall, and every person who bought at that wall is now trapped in a losing trade. Absorption is the sign that the smart money has decided that the price is high enough. They are no longer interested in higher prices. They are interested in liquidity, and you are providing it. In the next episode, we are going to talk about the test. I will show you how whales check if there is any supply or demand left before they start the real move. It is a game of shakeout, and if you do not have nerves of steel, they will shake you out of your position right before the gold mine opens. The wall is waiting. Are you ready to stop running into it? The Hidden Laws of Wealth series, Decoding the Market via Microeconomics. Chapter 2, Supply, Demand, and the Invisible Hand. Part 1, The Illusion of the Order Book. Episode 9, The Shakeout. testing the strength of the crowd. Imagine you are a general preparing for a massive invasion. You have your army ready, but you do not know how strong the enemy's defenses are. Do you just run in blindly? No. You send a small unit to fire a few shots. You provoke the enemy. You wait to see how they react. If they fire back with heavy artillery, you know they are still strong. If they do nothing, you know the path is clear. Oh, in the stock market, the whales do the exact same thing. We call it the test. Before a shark spends hundreds of millions of dollars to push a price higher, they must be sure that there is no floating supply left to stop them. They want to make sure that when they start the rocket, no one is going to dump shares on their head. In microeconomics, this is the search for the path of least resistance. So, how does a whale test the market? They create a shakeout. The price has been sideways for weeks. Everyone is bored. Suddenly, without any news, the whale places a large aggressive sell order. The price drops sharply, breaking a key support level. This is the probe. The shark is watching the reaction. If the volume stays low during the drop, it means the public is not interested in selling. The supply is exhausted. This is a successful test. The path to the moon is clear. But if the volume spikes on the drop, it means there are still too many weak hands ready to panic sell. The shark thinks, if I push the price up now, these people will sell into my rally and slow me down. So what do the sharks do? They do not buy it. They let the price stay down. They let it bleed. They want to frustrate you. They want to make you believe the market is dead. The shakeout is a psychological weapon. It is designed to transfer shares from the fearful to the patient. It is the final cleaning of the order book. Think about the cruelty of this. The shark knows the price is going to double. But before it does, he intentionally makes you lose 10% to force you to give up your position. He wants to be the only one on the train when it leaves the station. The most famous sign of a shakeout is a spring or a pin bar. The price dips below support, triggers all the stop losses, and then instantly closes back above the level on high volume. That high volume is not people selling. That high volume is the whale's mouth, opening wide to catch everything you just threw away. If you get shaken out, you are providing the very fuel the market needs to go up without. So, the next time you see a sudden, violent drop on no news, stop panicking. Look at the volume. Is it a massacre? Or is it just a test? In the final episode of this part, we are going to wrap everything up. I will show you how to combine the order book, the icebergs, the stop hunts, and the tests into one single clear vision. I will show you how to see the big picture before the rest of the world even realizes the game has started. The final test is coming. Are you ready to hold your ground? The Hidden Laws of Wealth Series, Decoding the Market via Microeconomics. Chapter 2, Supply, Demand, and the Invisible Hand. Part 1, The Illusion of the Order Book. Episode 10, The Big Picture, Seeing Through the Matrix. Welcome to the finale of Part 1. We have spent the last 9 episodes dismantling the lies of the market. You now know that the order book is a theater. You know that support levels are hunting grounds. You know that volume is the only truth. But knowing the pieces of the puzzle is not enough. You must see the picture. Most traders fail because they look for signals in isolation. They see a hammer candle and they buy. They see an SI divergence and they sell. They are like a soldier who hears a gunshot and starts shooting randomly into the bushes. The professional does not trade signals. The professional trades context. Context is the king. Yeah, context is the story that the pieces tell when you put them together. Let me give you the blueprint of a perfect trade. This is how I combine everything we have learned into a single lethal strategy. First, I look for location. I use the volume profile from episode 7. Am I at a high volume node where the giants are sleeping? Or am I in thin air? I never fight in the middle of nowhere. I wait until the price reaches a fortress. Second, I look for the trap. I remember episode 3 and episode 9. I wait for the stop hunt. I want to see the price dip below the support, scream in pain, and then get rejected. I want to see the blood of the weak hands. If there is no trap, there is no trade. Third, I look for absorption. I remember episode 8. As the price tries to fall further, I want to see the steel wall. High volume, flat price. I want to see the sellers exhausting themselves against the passive buy orders of the whale. Fourth, I look for aggression. I remember episode 6. I want to see the buyers wake up. I want to see market orders hitting the ass. I want to see the price jump away from the danger zone with speed and violence. And finally, I check the order book for icebergs. I want to make sure there is no hidden seller sitting right above my head, waiting to crush me. When all of these 5 things align, that is not a gamble. That is a crime scene. The footprints are fresh. The intention is clear. The probability is tilted heavily in your favor. This is what we call conflict. When supply exhaustion meets demand aggression at a key structural location, money is made. You are no longer a gambler. You are a detective. You are not betting on red or black. You are betting on the laws of physics. You are betting that a train hitting a wall must stop. You are betting that a vacuum must be filled. We have finished our tour of the order book. You now possess the X-ray vision to see through the numbers on your screen. You can spot the fake walls and the hidden traps. But the order book is only the battlefield. Who are the generals? Who decides when the war starts? And what happens when the biggest whale of all, the government, decides to enter the pool? In part 2 of chapter 2, we are going to leave the screen and enter the boardroom. We are going to talk about the invisible hand of the market makers and the central banks. We are going to discuss why the economy can be crashing while the stock market is hitting all-time highs. You have learned how to fight. Now you must learn how to rule. End of part 1.